Okay, in this video, we're going to start the very last chapter, chapter 6 of this course. We will not finish the entire chapter. We will definitely cover 6.1, 6.2. 6.3, we probably just briefly mention 6.3 because 6.3 is stock evaluation. And well, as you probably know, nothing really works when it comes to stock valuation, right? I mean, even the true professionals, the true traders, they don't agree on stock prices. For instance, how much should a Tesla stock should really be worth, right? Well, the consensus is definitely overpriced, but how much? Right? How much should be as somehow a fair price for Tesla? Nobody knows. So that's why even we do 6.3, it will be on the naive side. Don't use that to actually buy or sell stocks. Okay, 6.1 is rather straightforward. Here we introduce several types of financial instruments. We will mainly focus on money market instruments and bonds. Those two are the most important ones to us because the pricing of those products are directly linked to the essential topic we study in this course. That is the time value of money. Okay. So now let's begin. The first type we introduce is money market instruments. Okay, this is for this market. They are we call it the money market for several reasons. You can think them as cash-like investments, meaning it's relatively short-term. It's highly liquid. It has very low risk, and in the end, those are debt securities, right? So it's about borrowing, about loans. So when we talk about liquidity, a liquid asset is one that can be easily purchased and resold at a secondary market. So here, you can think secondary market as let's say stock exchange. Those are the secondary markets with very low transaction costs. For instance, what would be an illiquid asset? Right? Let's say real estate. It's a standard example of illiquid assets because when you want to sell a house, it's not easy, right? And the transaction fees are relatively high, right? So 5% to the agents, and usually it will take a long time. So that's why it's not considered as a liquid, but somehow for many let's say the U.S. Treasury Bills, the one we are going to introduce, are highly liquid. Okay. The money market is part of the fixed income market. So we call it the fixed income because the income generated by these instruments is fixed. So let's say we buy a coupon bond that gives us 5%. So if you buy it, let's say with $1,000, each year you will get $50 as coupon, right? It's fixed. So that's why it's called the fixed income market. Among all the money market instruments, arguably the most important one is the Treasury Bills. So Treasury Bills are short-term. So those are short-term debt instruments issued by the U.S. government. Of course, there are U.S. Treasury Bills. All governments issue their own short-term debt instruments. Right? For instance, Canadian governments also they also issue their Treasury Bills. Maybe they don't call it that way. Of course, it's going to be in Canadian dollars and it's backed by the Canadian government, right? In the textbook, the authors put that T-bills are currently issued with 4, 13, 26 week terms. In the secondary market, you can actually buy it at a slightly different terms. If you are really, really interested, you can just search Treasury Bills, and I think I have it in my website. So this is the website, right? It's called the Treasury Direct. Here it gives you actually more information. One thing we notice is you can have 4-week bill, 8-week bill, 13, 26, all the way to 52. Although textbook mentioned that 52 is currently not offered, but you should check. And more important is how you can purchase a Treasury bill, or how you can bid for a Treasury bill. Right? They are non-competitive bid, and they are competitive bids. In terms of trading stocks, you can think those two as market order and limit order. Right? So you can probably download a free software like Robinhood, and you can trade for a small amount of money, right? $20, $30, or $100. That's enough for you to get a good sense of different orders, right? And you can also somehow implement a semi-automatic orders. Let's say when the price hit some level, you're going to buy, or when the price drops to some level, you're going to sell, or when the loss reach certain percentage, you can sell. As long as you trade, you will understand everything, right? It's so much better than talking about it on paper, right? When you trade few amount of dollars, because many stocks are traded at very low prices. I mean, per share. Right? For instance, GM, right? It's very cheap, and there are many cheap stocks, right? That does not cost that much, but will give you a very valuable lesson in understanding different trade orders. Okay. For Treasury bills, they are the so-called zero coupon bonds, meaning they do not pay you any interest, in between, but rather the government promises to pay the face value back at the end of the term. So let's say if you purchase a 4-week Treasury bill, at the end of 4 weeks, you will receive the face amount. Okay, so that's everything. Since there are no coupons, investors buy Treasury bills at a discount. Okay, I think that the minimum amount you can purchase would be $100. So let's say you want to buy Treasury bills, just $100. Since there are no coupons, there are no interest payments in between, you will not pay 100 or more than 100, right? So you will actually pay at a discount. Let's say you pay $98, okay, for $100 Treasury bill. So the profit you actually earn is the difference, right? You pay 98. By the end of the term, you receive $100 back. In this specific example, you make a profit of $2, right? That's the distance or difference between the purchase price and the face value, okay? Other than that, you do not receive any interest payments. There are no coupons. So that's why we call those zero coupon bond, okay? A very attractive feature of T-bills is that the profit, okay, you make from T-bills are exempt from taxes. So that's great, right? When you trade stocks, the tax gains, the tax on gains, it's like close to 30%. That's really high, right? But for T-bills, they are tax free. So that's wonderful. So that's a huge benefit. That they are tax free. How can you price a T-bill? So this is very important. So I can even tell you for sure right now that there will be one question on exam 3. asking how you can price a T-bill. So it actually goes back to the very first chapter we studied, right? Different types of interest, different type of discount. We actually apply simple discount. Okay, so simple, so it's linear. Right? Assuming a 360 day a year, so that's that means we apply a specific day count rule. In this rule, we assume they are 360 days a year. The formula we are going to apply is as follows. So face value will be given. Okay, let's say $10,000. Those okay, the amount will be given, and the discount yield will be given as well. Then you apply this. Okay, the what you can see is because this is discount, right? So you will use 1 minus it, and discount yield is quoted on a yearly basis. So here it's on a yearly basis, right? And we already know Treasury bills are usually issued with less than a year, right? So we're going to convert into number of years. How we're going to do that? We use the number of days until maturity divided by the total number of days in a year. So n divided by 360 is going to give you a fraction number in the unit of years, right? Then discount, annual discount times this fractional unit will give you the discount for the specific Treasury bills you are trading, right? Then the face value times the 1 minus the discount will give you the price. So here I give you a quick example. We have an investor who wants to purchase a 91-day Treasury bill with a discount yield. So whenever we talk about discount yield, is a rate based on an annual basis. So this is annual discount yield of 3.47 and a face value of $10,000. So let's apply this formula, right? Face value, obviously $10,000. 1 minus the discount yield, which is 3.47%. Let's put it in decimals, okay? Times by, then we're going to convert your maturity into number of years, because here it's 91 days, right? So we convert this into years, would be 91 divided by 360. Okay, remember you divide by this, not 365. By the way, if I remember correctly, for Canadian bills, they divide by 365. Different governments or different departments of Treasury have different rules on that. For US, you divide by 360. Okay, then you get the price. So this is what I previously mentioned. Treasury bills are bought or sold at a discount, right? At the discount, meaning the price is actually less than the face value, right? Again, that's very obvious, because when you make investment, you want to make money, right? Since there are no interest payments, the only way you're going to make money is when your purchase price here is less than the face value, right? Because by the end of the maturity, you will receive the face value back from the US government, right? Meaning in the end of 91 days, you will get $10,000. So what you pay for this right will be less than $10,000, as is seen down there. As we have already seen here, the standard practice is to quote Treasury bills in discount yield. Okay, it's not the annual effective yield, right? If you are trying to convert it into annual effective, you can apply this formula. In other words, what you do is actually this: price times by, so let Y be the annual effective interest rate. Right, we apply compound interest down here. We will need to convert the number of days into number of years. So remember here, okay, we divided by 365, not 360. So here we use a 360-day rule. Here we use 365, okay, to convert it into number of years. We use face amount. So let's be consistent. Face amount, right? So upon doing some algebraic manipulations, you will get the formula down here, right? So that's very obvious. From here, you can see that the annual effective interest rate is actually different from the discount, right? That's because they have different meanings, right? So this is what we always call the D, right? Discount rate. This is, we used to use I to denote because this is the annual effective interest rate. So I and D are different. That's not surprising at all. That's Treasury bills. Okay, so what I want you to understand from Treasury bills. So first of all, you need to know they are issued by the U.S. government, and they are short term. They are never more than 1 year. Okay, so here it's 26 weeks means it's 6 months. The government can issue T-bills up to 1 year, so up to 52 weeks. Okay, and can be as short as 1 month. So 4 weeks, it's about 1 month, right? So roughly speaking, you can think Treasury bills as some short-term debt issued by the U.S. government with maturity ranging from 1 week to 1 year. So, and they are zero coupon bonds. Next, you need to know how to price Treasury bills, and it may be also good to know how to convert the discount yield into effective yield. Okay, that's everything you need to know about Treasury bills, at least for this course. The next one actually should be more accessible to you because all banks, let's say Bank of America, Key Bank, or TD, or any major banks, even small banks or online banks like Discover, they would like you to buy a CD, right? Certificate of deposits. If you live in the US, I'm sure you will receive some flyers from those banks, right? Advertising their CD interest rates is much higher than the saving rates, right? That's actually the case. For instance, right now for major banks, if you open a saving account, the interest rate is nearly zero. For instance, I used to have a saving account with Chase. They pretty much have nearly zero interest rate. Right? Of course, if you put, let's say, $100,000, you will get a little bit more than zero, right? But for most of the people, that you can think the interest rate is zero on your saving account. It's very close to zero. But at the same time, the CD, usually the CDs can offer much higher interest rate. So it could be 1%. Last year it was even 2%. I think I had a CD with Discover, and they even offered me 2%. Of course, it's not the case anymore. Due to the COVID, the government lowered the interest rate to pretty much zero. So it's now I think it's less than 1%. But still, less than 1%. It's 10 or even 100 times more than you could get from a standard saving account. So that's why you see a lot of flyers of CD. So from what I just mentioned, you already know, CD is a deposit with a bank that cannot be withdrawn on demand. Meaning, let's say I invest, let's say $5,000 into a CD for 1 year. In between, I cannot withdraw. Okay. Not exactly I can. If I really want to withdraw from a 1 year CD, let's say 2 months into the deposit, I will need to pay a huge penalty. it's likely that I will not get any interest. So meaning, you lose all your interest payment from CD, right? And the only reason why you invest in CD is because it has an attractive interest rate, right? So it's not worth to do the earlier withdrawal, because usually it earlier withdrawals likely incur a penalty. Sometimes you losing interest is not that bad, right? Sometimes a penalty maybe meaning you cannot get your $5,000 back. Maybe you will lose $100, but that's even worse than. That's why saving accounts are still popular, right? Because you can withdraw anytime you want, and they recalculate your interest based on your balance. So there are no penalties. Of course, there are also limitations on how many transactions you can make. For instance, I think I'm limited to six transactions, if I remember correctly. But if you have a checking account, usually that's unlimited. For saving account, it's limited. For certificate of deposit, you are not allowed it to do any transactions without penalty. So you can see the pros and cons of each type, right? Checking, usually there is zero interest. For saving, there is some interest, but very, very close to zero. For CD, significantly higher interest, but with more restrictions, okay? So I put here, the investors usually receive interest on a periodical basis. I remember it should be a quarterly basis, but of course it depends on what kind of CD you open with what kind of bank. In my case, I receive interest every quarter, so they will send me a statement telling me how much I have earned in the previous quarter. Okay. In most cases, interest rates are fixed because that's more convenient to sell, right? And it's possible to have floating interest rates. Again, it's relatively unusual for CD, but not entirely impossible. The same as mortgage, right? Most mortgages, and more than 80% of the mortgages are fixed, right? So those are the conventional mortgages, fixed with, let's say right now it's probably a little bit over 2%, to between 2 and 3%, depending on your credit score, right? Those are fixed. It can be also floating, right? It can be floating or fixed to some index, right? So if the index goes up, your interest rate goes up. If the index goes down, your interest rate goes down. So, but those are unconventional, and most people don't take a floating CD or floating mortgage because they feel insecure. Last, I want to mention that CDs are insured with FDIC, the same as your saving, the same as your checking. Those are insured with FDIC up to $100,000. The last type is comparing to the previous two is a little well, at least not accessible to the general public. That's because it's often used by large corporations to raise money over a short period. So it's always short term because we are talking about money market, right? So all of them are short term, unsecured. So it's unsecured, right? So here, Treasury bills are backed by the US government, meaning it's backed by the income of the government, like taxes. CDs are insured by the FDIC, but commercial papers are not. They are not secured, okay? So which means your investment can, well, on paper, become nothing, right? They are issued by large corporations. The typical terms range from 1 to 2 months, so very, very short term. But of course, it's possible that it can go, up to 270 days. But in most cases, it will be very short. The face value is usually a multiple of $100,000. because they want to raise relatively enough money for a small period. So usually it's when they have cash flow issues, but their business are doing fine. They don't want to sell assets because the business is doing so well, right? Keeping the underlying assets will generate more profits in the future, but over the short term, the company may face some cash flow difficulties, right? Let's say it has issue paying some debt. Okay, so in 1 month there are 1 million debt coming, and the company does not want to sell any valuable assets to meet the debt obligations. Then it can issue a short-term commercial paper, right, saying that okay, I will pay back this 1 million with an interest rate of, let's say, 5%, right? Very attractive interest rate for 1 month, but I will use my revenue to, you know, somehow to convince you to invest in this commercial paper. Okay, so so if you put them together, right, there are many comparisons you can do, right? Treasury bills is backed by the government, probably the one you trust the most. CDs are issued by banks, you know, of course you trust the banks, right? And they are further issued, they are further insured by the FDIC. And finally, here are the commercial papers. Of course, they are more risky than the previous two because they are only issued by large corporations. Okay, of course, those corporations are well-known companies, and it's probably less likely that they will go bankrupt within 1 or 2 months. But still, there is significantly higher risk because they are not backed by anything, right? They are backed by the company, right? So if you trust the company, you invest, but of course there is default risk. The second type is not new, right? Bonds. We have been studying bonds for quite some time in this course. Not exactly the bonds we mentioned here, but you know, annuities are very close to bonds, right? So a bond is a debt instrument that requires the issue to repay the initial principal plus interest. So in that sense, the cash flows of a bond is nearly identical to a level annuity, right? So the so let's assume it's the payments are on a yearly basis. So at the end of each year, you will receive some coupons, right? Those coupons are the interest payments. So coupons are the interest payments. So they are usually on an annual basis or semi-annual basis. Of course, can be at different frequency, but usually those two are more common, with semi-annual being the dominant choice. At the end of each year, or at the end of each or at the end of each 6 months, the holder will receive some coupons. Okay, so let's say the face value is $1,000. Interest rate is 5%. Then at the end of each year, the bond holders will receive $50, right? And at the end of, let's say, this is a 5-year bond. At the end of 5 years, not only you will get the final coupon of $50, you will also get the face value $1,000 back. Okay, it looks very close to annuity except the final part, right? So you can think bond as annuity plus a lump sum payment at the maturity time, right? So that's the cash flows of bonds. Usually they are issued by, it can be a government, can be a corporation. By the way, the US government also issues bonds, right? They are not called Treasury bills. They are called Treasury Notes. So you can Google. Treasury Notes can be issued up to 30 years. So for bonds, the terms usually range from 1 year to 30 years. Sometimes we call those with relatively short terms, say less than 10 years, we call them a note, just the notation or terminology. The good thing of bonds is that the interest payments are tax deductible, right? Deductible, not tax free. Okay. Treasury bills are tax free. Bond, the revenues or the interest payments are tax deductible. They give you some kind of tax advantage. One particular thing is that bondholders have high seniority in the issuer's assets than shareholders, okay, when it goes bankrupt. Meaning, let's say a company, okay, has a debt of, let's say, $10 million. And the company's total assets, right now, it's only worth $8 million. So of course, it will go bankrupt. In this case, since the company's assets is not enough to pay back the debt, all the shareholders will receive nothing. It has not. It doesn't matter whether the stock price is 1 or 2 or 10 cents or 20 cents. Shareholders receive nothing. So eventually, their share values are zero because bondholders have high seniority. So they can claim the company's assets before the shareholders. Okay, because shareholders are considered owners of the company, right? So if your company owes another party $10 million, you are supposed to use your 8 million assets to pay the debts first, right? If there's extra, you can distribute to shareholders. In my example, there is no extra, right? You only have 8 million assets, but you own somebody else $10 million. Of course, you're going to use whatever you have to pay proportionally to the bondholders, okay? Depending on the interest rates, you can divide bonds into fixed rate, floating rate, and zero coupon, right? Zero coupon means zero interest rate, right? And when interest rate is bigger than zero, they may be fixed, they may be floating, right? That's easy to understand. And here we have two special bonds. We don't study them because they are too complicated. One type is called the callable bond. Callable is on the viewpoint of the issuer. So meaning the companies, right? This bond gives the issuer the right or the option to repay the principal earlier, so before the maturity, right? So to the investors, probably this is not entirely good news because you will not receive the coupon payments, right? Once the issuer repay back the principal, right? So this is to the advantage of the issuer, okay? Let's say using our real life example, if you think mortgage as a bond, in most cases, the issuer, in this case, it's a household, right, have the option to repay the mortgage earlier. And in Connecticut, there is no penalty. So if you have enough money to pay your mortgage before the maturity, you can do it now and save a lot of money on interest, right? It is bad news to the banks, right, because they no longer they cannot collect any interest from you once you repay the entire mortgage, right, before the maturity. So it is to the advantage of the issuer. There are also convertible bonds. Okay, those bonds are to the advantage of the holders because they can decide whether I convert my bond into stocks, right? So this kind of bond gives the holders the option to convert the bond into stocks because bonds are usually relatively stable, right? Let's say this is a fixed rate bond. Then what you receive, you already know, right? There is no risk if the company does not default. Okay, so let's say in one of my earlier examples, I say you receive $50 each year, right? So you see the fixed income right? But maybe that company is doing so well, the stock price it's skyrocketing. Let's say like Zoom, right? You probably don't want to hold the bond of Zoom if you have the option to convert into stocks, right? So this kind of bond is to the advantage of holders, okay? But it's more difficult to price because the bondholder has the option to exchange, but not obligation. Meaning you can choose to convert or not, right? If the stock price is going well, if you think the price is going to continue to go up, you can convert, right? If the price is very low, you don't need to convert, right? Depending on your expectations. It's a right, not obligation. Any right will be priced. So because it's additional advantage, right? So pricing convertible bonds, it's obviously more complex and we don't deal. The last several are, well, they are common in our daily life, right? The third one is even called common stocks. I actually encourage you to trade a small amount of stocks to get a better sense of finance. Okay, don't trade too much. Okay, maybe $100 is enough for you to get a good sense of what common stocks look like, right? What it feels to be an owner of, let's say, Amazon, of Apple. For instance, the app I mentioned, Robinhood, actually allows you to buy very expensive stocks at a fractional share. Let's say, Amazon might be too expensive for you, right? $3,000, right? A share is a lot for you, for a student, but you can also invest the $10, right? You can be a fractional owner, right? You do not own an entire share, but you can own 1/20 share of Amazon, right? So it gives you a sense of being an owner of some company. Okay, some stocks pay dividends, some don't, right? So some of the stocks I invested, like Microsoft, like Visa, like PayPal, they pay dividends. Some don't. 3 and 4 are both stocks. Okay, common stocks are the ones we usually talk about. Those you can trade on the exchanges. Preferred stocks they are not exactly stocks. They are hybrid between stocks and debt. I say that they are hybrid because they share both properties of a common stock and a bond. So with bond, or similar to a bond, a preferred stock also gives its owners some fixed payments. Okay, we also call this dividends. This dividend is not the same as the dividends of common stocks. Okay, that's why it may be safer to just call them fixed payments. Okay, that is very similar to bond coupons, right? You receive some fixed payments. But unlike bonds, okay, pretty much all the bonds have a fixed term, like 1 year, 2 year, 10 years, 30 years. But for many preferred stocks, there are no maturity, which means you can pass it on generation to generation. But it can be the case that the issuer can buy it back, meaning they don't want you to hold it forever, right? And in terms of seniority, debt has the highest. So whenever a company goes bankrupt, the debt owners can claim on the company's assets first, and then it goes to preferred stockholders, and finally goes to common stockholders. Cons with preferred stocks, they are not owners, so usually they do not have the voting right, and there are many subclasses among preferred stocks, meaning they may be preferred stock 1. They have the highest seniority among all preferred stocks, and they are preferred stock 2, preferred stock 3. They can be different subclasses. Finally, there are a few mutual funds. We know this all the time. Whenever you after graduation you get a job, you will need to contribute to pension, right? Pension will invest in mutual funds. Those are managed by big companies like Vanguard. It's a very famous company that has a lot of mutual funds. Mutual funds are good because it allows small investor to do big things. So let's say I only have, let's say $5,000. If I want to invest in the stock market, I can only buy very, very few stocks, right? So $5,000 is not enough even to buy 2 Amazon shares, right? So it's very difficult for a small investor like me to diversify in this huge stock market, right? But I can put my $5,000 with a mutual fund. And because they are pooled investments, they can invest in pretty much all the stocks, right? So I own a fraction in a lot of shares. So that saves me a lot of trouble doing the transactions myself. And because they are very big investors, right? They are pooled, right? For many Vanguard funds, they have assets with 100 or even more than $100 billion. So they are huge funds, right? They have better price, right? They get better price than a small investor like me. So, and also I don't need to do a lot of management. They do everything for me, right? Of course, I will need to pay some management fees to them. The last two, I don't want to actually talk. I leave those as you to read. The reason is because we don't really discuss those in this course. You will study derivatives in later course. Of course, options are very, very important, right? Forwards, futures, well, futures at least are more important. And swaps, caps, and floors are among the most traded products in fixed income. They are highly, highly popular. So let me end here for the first section.